While the mainstream media and your favorite finance gurus are still buzzing about gold's amazing run in 2025, they are completely ignoring the blaring red warning signs. They see a dip, I see a cliff. The party for gold is over. It was fun while it lasted, but a brutal hangover is coming. We just saw the sharpest single-day correction in years, and I'm here to tell you, this isn't just some healthy pullback. This is the opening act for a much bigger show, a potential 50% crash in the price of gold. In this video, I'm going to break down the 3 huge macroeconomic triggers that are set to send gold tumbling. And, more importantly, I'm going to show you the specific stealth investments to make right now, before the collapse. Section 1. The unraveling of a record rally. Let's be clear, 2025 was a spectacular year for gold. We saw a historic rally, with prices surging and breaking through all-time highs to trade above $4,100 an ounce. For months, the story was simple: runaway inflation, geopolitical turmoil, and economic uncertainty made gold the undisputed king of safe havens. Week after week, it felt like the only way was up. And then, the floor fell out. In late 2025, the market was hit with a brutal shock, the steepest single-day price drop in years, a violent unwinding that erased weeks of gains in a few hours. Prices plunged, and the slide didn't stop there. Suddenly, the invincible asset looked incredibly fragile. Of course, the bulls are calling this a technical correction and a buying opportunity. Major banks are sticking to their bullish forecasts, with some like Goldman Sachs and Morgan Stanley calling for prices to hit $4,400 or even push toward $4,900 by the end of 2026. They want you to believe the story hasn't changed. But they're wrong. The ground beneath the gold market is fundamentally shifting, and this recent drop was just the first tremor before the earthquake. Section 2. The 3 macroeconomic triggers for collapse. So what's really happening behind the scenes? Why is the gold rally about to slam into a wall and reverse? It comes down to 3 powerful macroeconomic forces that are all aligning against it. First, the undeniable resurgence of the US dollar. The US dollar index, or DXY, has been showing renewed strength, recently trading in the high 90s and pushing towards 100. Forgetting this simple fact is one of the biggest mistakes a gold investor can make. Gold is priced in dollars, so when the dollar gets stronger, gold automatically gets more expensive, or every buyer using another currency. This puts a huge damper on global demand. The relationship is almost instinctual in the markets. A strong rally in the dollar acts like a giant anchor, pulling gold down with it. The second trigger is the Federal Reserve's ironclad commitment to higher for longer interest rates. This is pure poison for gold. Gold is a zero-yield asset. It pays you nothing, no dividend, no interest. When you can get a safe, guaranteed return from treasury bonds, the opportunity cost of holding a non-yielding lump of metal becomes incredibly high. The Fed's tough talk about keeping rates elevated to kill any last embers of inflation is a massive headwind for gold. Why hold gold when cash itself has become a higher performing asset? Finally, the third trigger, the quiet disappearance of gold's biggest selling points, inflation and fear. For the last couple of years, the main reason to own gold was as a hedge against soaring inflation and geopolitical chaos. But just look at the data now. US inflation, while sticky, has cooled significantly, with recent readings around 3.2%. In the Eurozone, it's even lower, easing to 2.1% in October. The inflation dragon has been wounded. At the same time, while the world is far from perfect, we've seen a reduction in some major geopolitical flare-ups. As fear recedes and inflation normalizes, the urgent, desperate reason for holding gold as a crisis hedge is simply evaporating. Section 3. The anatomy of the impending sell-off. These macroeconomic triggers are the fuel, but the market structure itself is the accelerant. After its massive run-up, gold became dangerously overbought. The Relative Strength Index, or RSI, was screaming overbought for weeks, a clear sign the rally was running on fumes. This is where the big, institutional players, the so-called smart money, quietly head for the exits. They aren't panicking, they are methodically taking profits. This leads to massive outflows from gold ETFs, which forces fund managers to sell physical gold to meet redemptions, creating a new wave of selling pressure. This is where the retail investor gets caught. While central banks and institutional players were the main drivers of the rally, a huge wave of retail money flooded into gold near the top, chasing the hype. But when those big institutional sell orders hit and key psychological price levels like $4,100 and $4,000 were breached, it triggered a cascade of automated stop-loss orders and, more importantly, human panic. This is how a correction turns into a rout. The very people who bought gold for safety become the biggest sellers in a downturn. Now, some will point to reports that physical gold is just moving from Western ETF vaults to private vaults in the East, framing this as a sign of strength. Don't be fooled. This is a story of two different markets. The price you see on your screen is set by the paper market, futures, options, and ETFs. The physical market is for long-term wealth preservation. When the speculative paper money flees, the price will crash no matter where the physical bars are sitting. That transfer just shows the fast money is gone, leaving the market dangerously illiquid and vulnerable to shocks. If this analysis is giving you a new perspective on the market, do me a favor and hit that subscribe button and turn on notifications. The financial world is shifting fast, and my job is to keep you ahead of the curve. You won't want to miss the solutions we're about to get into. Section 4, the stealth play. How to profit from the crash. Okay, so I've laid out the problem. The logical question is, what do you do about it? If you think this has a real chance of playing out, you don't have to just watch from the sidelines. There are specific, actionable strategies, stealth plays, that sophisticated investors use to hedge against, and even profit from, a major downturn in gold. But first, a quick and necessary disclaimer. These are not your typical buy and hold strategies. They involve shorting and leverage, which carry significant risk and aren't for everyone. This is for educational purposes, so please do your own research. Stealth play number 1, the direct short. The most straightforward way to bet against gold is to short it. You could short gold futures, but that's complex for most people. A much easier way is through inverse ETFs. These are funds designed to go up when the price of gold goes down. For example, the DB Gold Short ETN, ticker DGZ, gives you inverse exposure to gold's daily performance. For those with a higher risk tolerance, there are leveraged inverse ETFs, like the ProShares Ultra Short Gold ETF, ticker GLL. This fund aims to deliver double the inverse return of gold's daily move. So if gold drops 5%, GLL aims to rise 10%. Be warned that leverage cuts both ways, and these tools are built for short-term trades, not long-term holds. Stealth play number 2, the relative value trade. This is a classic pairs trade that profits from a rotation out of safety and into risk. The strategy is simple. You go short gold while simultaneously going long on a stock index or a sector that does well when fear subsides and confidence returns. For instance, you could short gold and go long the consumer discretionary sector. The thinking is that the same forces pushing gold down, lower inflation, stable growth, are the very things that will push stocks in areas like travel, entertainment, and retail higher. You aren't just betting on a gold crash, you're betting on what that crash means for the rest of the economy. Stealth play number 3, the king dollar trade. As we established, a primary driver of gold's weakness is the dollar's strength. The two often move in opposite directions. So, instead of or in addition to shorting gold, you can just go long the US dollar. It's a cleaner and often more direct way to trade this macroeconomic idea. You can do this easily through ETFs that track the US dollar index, like the Invesco DB US Dollar Index Bullish Fund, ticker UUP. If the scenario of a flight to dollar safety and a sell-off in assets like gold plays out, this trade is perfectly positioned. Section 5, is a 50% crash really possible? Now, let's address the headline, is a 50% crash, a fall from a peak near $4,200 down to around $2,100, really possible? Let's be very clear, this is a bold contrarian prediction. This is not the consensus view. As I mentioned, major financial institutions remain bullish. A crash of this size would be almost unheard of in modern history without a world-altering event. It would likely take a perfect storm, the Federal Reserve getting even more aggressive than anyone expects, a complete resolution of global conflicts, a massive and sustained global economic boom that makes safe havens totally irrelevant, and a technical breakdown of every single long-term support level for gold. So, why even consider it? Because the most successful investors don't just plan for the most likely outcome, they prepare for the most impactful ones. The risk here is asymmetrical. While the consensus sees a 10 to 20% correction, they are ignoring the fragility built into this market. A 50% decline is a low probability, but extremely high impact event. Thinking about these scenarios and understanding the plays you could make is what separates the average investor from those prepared to protect their capital and seize rare opportunities. So, to sum it all up, the record-breaking gold rally of 2025 has created a dangerous sense of complacency. But the party is ending. Three powerful macroeconomic forces, a surging US dollar, stubbornly high interest rates, and fading inflation and fear, are aligning to trigger a major reversal. This isn't just a small dip, it's the start of a potential crash that could cut the price of gold in half. While the mainstream tells you to buy the dip, I've shown you the stealth plays the pros will be using, directly shorting gold with inverse ETFs like GL, setting up a relative value trade against stocks, or making a clean bet on the US dollar's continued strength. These are the tools to turn a market crisis into a financial opportunity. Now I want to hear from you. Do you think gold is heading for a major crash, or is this just a temporary correction before the next leg up? Let me know your thoughts and your price targets in the comments below. And if you want more deep dive analyses that go against the grain, make sure you're subscribed. Thanks for watching.